You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
Hey everyone, welcome back to another episode of Market Champions. Today I've got Arjun Murti. Arjun is a partner at Veriten Research. Arjun was formerly a partner at Goldman Sachs, where he ran the commodity equity research division. And in addition, he also publishes a Substack called Super Spike, as well as a podcast by the same name. So Arjun, thank you so much for being on the podcast. It's awesome to have you on.
Sri, thanks for having me. It's great to be here.
Awesome. Arjun, can we start by talking a bit about your background, kind of how you got into the business and, how you got to where you are today?
Yeah, sure. I mean, it's a lot by chance and by luck. So I ended up going to the University of Denver, and a professor of mine said, hey, there's this investment bank looking for a junior analyst, and it happened to be Petrie Parkman. They specialized in the E&P sector. I remember I had to keep looking up those words because I didn't quite understand what it meant. And so I was a junior research analyst out of college, and that's how I got my career started in the energy sector. I always loved analyzing stocks and equities and sort of being a markets person, and probably never appreciated that the energy sector would be so fun and so fascinating. So, after Petrie, I went on to the buy side at JP Morgan, then to Goldman Sachs, as you mentioned. So I was on the buy side for 4 years. I've been on the sell side for the bulk of the first 22 years of my career, retired as a partner at Goldman, and then have been doing mostly board and advisory work for the last decade until joining Veriten earlier this year. Kind of some desire to come back on the front lines. I like their business model of helping energy companies, or I should say companies, it's not just energy, think through what is, I think, a very messy energy transition. So while a lot of our sort of company clients are skewed a little bit more to the oil and gas space, that is not entirely the case. We are open to sort of all companies, including around the world. And it's been a lot of fun to both be writing Super Spiked and to be kind of back in person or back on the front lines at Veriten. So
that's awesome. And I guess just to start off with the first bit of your career, I think it's very, very cool that you used to be a partner at Goldman Sachs, and you were kind of there kind of in almost what you could call the heyday of finance, back kind of the 1990s, 2000s, and the 2010s. And I don't know if you have any cool stories, if you could share what that experience was like, or important lessons that you learned while you were there.
I mean, the bulk of my career at Goldman, and I was at Goldman for specifically from 99 to 2014. I mean, this really was sort of the start of sort of what I call the super spike era. It's the namesake for my blog and podcast now, but that's sort of going through that super cycle. I'll tell you, I launched coverage in 1999, and this was at the height of the tech boom. And I specifically remember I was about to launch coverage on what we call, I think, our 410 call. It was after the close. And I remember meeting some hotshot tech analyst, and he said, hey, nice to meet you. We exchanged names. So I was like, I was like, what do you cover? And he was some internet, .com bubble sector that I'd never heard of, which sounded interesting. He's like, what do you cover? I was like, well, I'm going to be covering the integrated oils. He's like, oh, I'm sorry to hear that. He wasn't making fun of me. He was sincerely sorry to hear. He felt like actual compassion that I was stuck with this, very old school energy space. And I will tell you, back in those days, Exxon and the large integrateds were always a large portion of the S&P, so that even when oil prices of the sector might have been out of favor because oil was down, as was the case in 99, the sector sort of always had a relevance to it that I think is one of the issues that is faced more recently, which is your S&P weighting sufficiently that people have to care? And so despite his sort of concern about my well-being of covering these integrated oils, I felt good that even if oil was to stay out of favor, people were definitely going to care about our call for Exxon and Mobil and Chevron and Texaco and all the names, as well as whether oil was going to be 25 or 15 was kind of the call back then. So it was the start. I actually felt good that, hey, I had a relevant sector even if it was out of favor. And then of course the whole super cycle took hold, and I was fortunate, along with my colleagues. I know when we met, my colleague Jeff Curry and I kind of grew up together at Goldman, and we kind of both we're partners through that super spike era, as I called it. He called it revenge on the old economy. It was really a great time to be at Goldman and a lot of fun. So
yeah, no, that is amazing. And since you said you started off in 1999, so were you did you cover, or were you one of the people who covered Enron, kind of as it went bust? And in that time period?
I'll tell you a little Enron story. So, we had a team that covered it at Goldman, and I do remember one of the junior analysts. I'll keep him nameless, though it's not impossible to figure it out. Who came into my office just extremely upset about Enron. He's like, "Listen, I've gone through these 10Ks, 10Qs, 8Ks. This just doesn't add up, and I can't continue on." And I'll always remember that this young analyst at the time. And the person he worked for was an Enron bull. I actually don't fault the person for those views. It was a different era, and I believe that person believed the call that he was making, and wasn't able to himself uncover the fraud that ended up having at Enron. But this younger analyst had the guts to say, "I don't trust this, and I have to live by my conscience." So he ended up resigning from Goldman Sachs. He went on to having frankly, a great career as an investor and doing other things, both in the proprietary trading world at Goldman and then at his own firm right now. But the point being that he did the work, he did the analysis, couldn't get the numbers to add up, and made what I would call a decision of conscience, which is, I can't be part of something I don't understand. And the person he worked for, I know he had huge respect for and still does. That person has since passed away, sadly. It was David Fleischer. I think everyone knows was the Enron analyst in those days. And I personally really loved working with David. This was his one blind spot, was Enron. But this junior analyst, what an unbelievable call to make, that I can't be part of this. I'm leaving Goldman Sachs. And it's always stuck with me, as sort of do the work, and you have to live by your decisions. And the junior analyst certainly did. So
100%. And yeah, just having that level of conviction, even though he was kind of, more of a junior person, and that's pretty crazy.
I'll tell you one other Enron story. This is actually when I was at JP Morgan, and this is before they were known to be fraudulent. And we had a veteran utilities analyst. This woman had been covering the utility sector at that time, probably for 30 years. And I remember Jeff Skilling came in just after they bought Portland General, which was a Portland, Oregon-based utility, and was part of their move to gas trading and so forth. And this was, again, before really Enron took off as sort of a fraud stock and a bubble stock and all those things. They were still viewed as a legitimate pipeline company, which they were originally. And this person said, "Hey, Jeff Skilling just told us some stuff about Portland General that I know is a lie. This isn't about differences in opinion. This isn't I think this or he thinks that. I don't know why he's lying, but I do not trust him, and there is no chance we're ever going to invest in Enron." And she just could not get over what she viewed as and she took a lot of heat and a lot of pressure, because especially as Enron started taking off, the view as well, they're a pipeline company. You're more of an old school utilities analyst. You're just missing some stuff. And I will always remember that she, again, stood by her conviction that this is not a matter of opinion. Jeff Skilling is lying to me, and I am not going to stand and tolerate that, and we should not either. And she, as I recall, it's been a long time now, she did get moved off of covering Enron. I don't recall it being a big stock for JP Morgan either way, so it probably didn't matter at the end of the day. But again, there's someone who stood, one person I mentioned is junior analyst. This is a veteran analyst, both for different reasons stuck by their conviction, and both were proven to be correct in a very big way. So
that is amazing. Yeah, I mean, yeah, that just having that level of conviction, it's awesome. And I guess moving on, to more of what's going on in energy markets today. So I guess so we're recording this on the 10th of October. So over the last couple of days, it's been quite interesting, especially with what's going on in the Middle East, with attacks on Israel, and additional unrest. So I just wanted to get, your take on how you're thinking about it, especially from your geopolitical framework.
Yeah, and I think there's a lot of important lessons out of this. I mean, obviously, it is horrific, the images that we're seeing out of there, and it's hard to talk about these things. But other than expressing remorse and condolences to everyone who's been negatively impacted, and it is really horrific, some of the images. But if we turn to oil markets, I do think there are just a number of important lessons that keep arising again and again and again. And that is, on the one hand, this is why folks want to motivate into why energy transition can exist. It can exist not just for climate reasons, for geopolitical reasons. So to the extent, obviously not Israel specifically, but the broader region, Iran, Saudi, et cetera, the Middle East is an important oil producing region. I would say this is a motivation, A, for why people want to transition, but also B, why we need a healthy and robust and strong American and Canadian oil and gas industry to counterbalance overexposure to the Middle East. And it is perplexing that we have to keep learning these lessons over and over again. There's a lot we don't know about the terrorist attacks in Israel and what might transfold or who's responsible exactly or what the consequences may be. That again, here on October 10th, it does spotlight, listen, the risk of a broader Middle East conflict is obviously there. It's always been there. It's cropping up again. We, of course, a year ago had Russia's now still ongoing invasion of Ukraine. And so here you got some major either oil producers or oil producing region. And again, the motivations are going to be twofold. It is why folks will want to reduce their dependence on the inherent instability that comes with oil in particular, and to a lesser degree, LNG. But I think it's also why we need to continue to invest in at least in areas that are allies and friends of our interests. So for the US, that would be Canada. For Canada, it's presumably the US. And I think the world is in a much better spot today than it was 20 or 30 or 50 years ago to deal with potential disruptions. It doesn't mean it won't be painful for consumers via higher gasoline prices, which impacts everybody. But certainly having the kind of shale growth we've seen in the U.S., the kind of oil sands and other growth we've seen out of Canada puts at least our two countries, U.S. and Canada, in a better position, relatively speaking, than was the case 25 years ago. And again, people need to wrap their minds around, you have to do it all. You can say we're motivated to reduce our dependence in oil. That's fine to say that. And I support steps that improve efficiency. And I personally am an electric vehicle driver. I don't think that's the answer for everybody, but at least for some people, it might be one of the solutions. But we also still need a very healthy, robust traditional oil and gas sector while we are still using 100 million barrels a day of oil demand, which a number that, by the way, is going to continue to grow, in my opinion, for the foreseeable future based on developing market growth. And I think, the tragic events of this past week are a reminder that we do need all of the above when we talk about energy transition and these kinds of topics.
Got it. That makes a lot of sense. And I think, this goes down to what you call disruption countries risk. And, this is something we saw when Russia invaded the Ukraine. And, considering a lot of Western Europe, especially countries like Germany, heavily relied on Russia for natural gas supply, etc., and general energy supply, etc. That kind of made a big difference. And when it comes to thinking about this disruption countries risk, how do you what's kind of your geopolitical framework? How do you kind of think about it, especially from the perspective that Russia Ukraine could very well have been like a short-term disruption versus something that actually contributes long-term to oil supply structure and oil prices.
Yeah, I mean, there's actually a lot to unpack in that question. So I think on the one hand, folks will say, well, it's hard to forecast the geopolitical risk, disruption, or turmoil. Certainly, no one, I think, could have forecast either what happened last weekend or Russia a year ago, and then tried to guess what the impact may be. And of course, we went to 120, then came back down to 67 a year later so, I'd say a couple different answers here. One is that, I've tried to aggregate the countries that are routinely have issues. So in this case, it would have been Libya, Nigeria, and a few other places like that. And you do see a pattern where the production is sort of either on or off, if you will. And Venezuela was another one in that bucket, and Iran was the fourth country, where there's a little bit of a cyclicality to whether these countries are kind of quote on or quote off. If you apply that framework to Iran today, production has ramped up meaningfully over the last couple of years under the Biden administration. And I think you might argue that their production is currently on, quote unquote. There's probably a greater probability, especially after the last week, that it goes back, quote, off at some point in time. So there's kind of that's one element and I think that more impacts some of the short-term trading around oil, thinking about whether these aggregated countries are getting better or getting worse. I think the longer-term issue is one of, what kind of spare capacity in the OPEC countries do we have or not have? And what is the scope for non-OPEC supply to grow or not grow? And I think on those 2 points, my personal view, and it's been true really since the 2000s, is that there is really very little OPEC spare capacity. Even Saudi, I'm not sure, they have never really sustained over 10.5 million barrels a day. They've currently cut production to 9 to try and prop up the oil market. I think that has been in the short term more successful than even I might have anticipated. But whether it's successful or not, that leaves 1.5 million barrels a day of spare capacity. And there may be a little bit in UAE and some of the other countries, but I think we have a really small cushion, which if you then did have a bigger disruption, say in the Middle East or elsewhere, which we haven't had. Like, I think people thought when Russia attacked Ukraine, they would have a supply disruption. They clearly have not. Maybe it hasn't stopped growing, but it certainly hasn't shrunk. I think the same questions and the same observation will be applied to the Middle East. Will there be a more sizable disruption or not? Again, Russia, we thought there would be. They showed they were able to overcome sanctions. They were able to redirect oil flows to China and India. And so while they might be facing a higher transportation cost, it's been irrelevant from the context of global oil markets. So I think we'll have to see when it comes to the Middle East what is going to transpire, other than our starting point is not much by way of spare capacity cushion. That limited spare capacity, though, has not resulted in only a bullish market. As we know, from 2015 to 2020, it was a pretty bearish market because the world didn't need OPEC spare capacity or growth to meet demand growth. It all overwhelmingly came from U.S. shale, and then secondarily, actually, from Canada. If you add up U.S. and Canada, it's 100% of net global oil supply, which is a remarkable figure. And about 90% of that is U.S. shale. So it's been an overwhelming positive supply story out of U.S. shale, which means that simply saying OPEC spare capacity is limited cannot in and of itself be declared a bullish or bearish statement. It's merely a signpost. I'd say the signposts today are, it looks like U.S. shale is starting to mature. So when it's been 90% of our global supply, we should wonder about that. We can debate whether it's rolling over or only declining because the rig count is falling. Like, there's a whole bunch of short-termism with shale. But I think I feel like everyone would agree, and it's not too controversial to say, those days of 1 to 1.5 million barrels a day of shale oil supply growth are kind of behind us. And so therefore, with the cost curve steepening, there are fewer projects being pursued. No one's even trying to grow new supply. You don't have the sort of flood of CapEx like we saw 20 years ago. You combine that with the geopolitical turmoil we're seeing in the Middle East, and it certainly creates the prospects for a new super cycle to arrive. I've not said we're in a new super cycle. As you know, Sri, I've used the super vol language. That is because of the economic uncertainty in China, the US, and Europe. But I think if you ever got through that, and maybe that's a year from now, maybe it's 3 years from now, this notion of limited OPEC spare capacity, geopolitical turmoil, shale maturing, and no one trying to grow supply, that would be the environment where you say perhaps a new super cycle is upon us. So sorry for the long answer there, but it's a really good question.
Got it. No. That was a great answer as well. And I think I think we can jump, deeper into, a lot of different things that you mentioned in that answer. So, as you've mentioned, kind of, you're not, openly in the super cycle camp, which has gained a lot of traction, especially, within FinSwed, et cetera. And so when you think about, and, as you mentioned, when you think about, these geopolitical events, right, as soon as Russia invaded the Ukraine, we saw oil jump up to 120 and then fall right back down over the next 6 to 8 months, back down to 60, 70. And, they seem to be more of a short-term supply disruption, versus, what you would think about, when it comes to the factors for a longer-term super cycle. So, could you, for anyone who might not be aware, so could you kind of go into your view on, why you've kind of not explicitly came out with, we are in a super cycle view, and what it would actually take for you to go into that camp, what it would actually take for a super cycle to happen.
Yeah, thank you. It's a great question, and it's definitely worth unpacking, because I should probably try and be clear in a few different points, which is, I actually think we're in perhaps a super cycle for profitability for the sector, in the sense that I think returns on capital over the next 10 years are going to be significantly better than they were over the last 10 years, which was a pretty poor period. And there is an observation that the cycle over 100 plus years cycles in sort of 10 to 15 years of good years, 10 to 15 years of bad years. We're coming off bad. And for a variety of reasons, we expect a pretty good decade going forward, though I think it's going to be quite choppy. So in terms of super cycle versus super vol, I think even there, if you added up all the ups and downs of 120, 67, whatever we're going to now, whatever we pull back to, that might average what we might consider a, quote, bullish oil price. So I think those days of sort of $50 oil and kind of being between 40 and 60, I think those are behind us. So I think overall over the next decade, we will be in a sort of a generally higher price environment. But I still have resisted the super cycle language, mainly because it implies kind of a smoothness to the upcycle and a magnitude of gain that I think could happen but isn't on track to happen like right now or perhaps over the next year. And what I mean by that is, if you look at the 70s and the 2000s, when oil started moving, it moved in multiples. So we went from $3 in the start of the 1970s to, in nominal terms, ultimately $30, a tenfold increase in oil prices. It wasn't a traded market. It was a different kind of market, but we went up tenfold. In the 2000s, we were basically around $20 nominal, and we ended up a decade later around $100 a barrel with a lot of noise along the way, but it was a pretty steady march higher between 04 and 07. We then had the financial crisis, and then 09, 10, 11, 12, 13, 14. We went back to 100 and kind of stayed there for a few. That was a five-fold increase. Right now, we're kind of talking, we were kind of in the 50s. We've gotten to 120. We've generally been between 70 and 90. Like, so far, we definitively have not had a super cycle. So for anyone saying a super cycle is here, all I'd say is it has been super choppy and it hasn't started. And I do feel like it has been more of a super vol environment thus far, and almost definitionally not a super cycle, at least not yet. And then the question is, when is this transition? And so as recently as last week, I started writing about what would it take to have super cycle 2? And I think it means to me a couple different things. One thing that happened 20 years ago is when oil first went from 20 to 30 to 40 to 50, everyone was very concerned that it would hurt economic growth. And in fact, economic growth, quote unquote, didn't care. Or said another way, the BRICS expansion in China, it just didn't matter that oil had risen. Their economies were moving up the S curve, and that overwhelmed any kind of near-term hit to people driving their cars or what have you. And it was a really just almost a straight up and to the right environment. And we also saw that everyone was disappointed on their production growth forecasts. It became clear that OPEC was out of spare capacity, and people were trying to spend. They were trying to increase the rig count. They were trying to develop deep water, Russia, Arctic, oil sands, all these different things, and they were struggling to really add the supply in any sort of reasonable time frame. We like have none of those conditions today. Like oil went to 120, and almost certainly there was some weakening in the economic health of Europe, China, and the US. And I think while perhaps recession has been avoided, at least in the US and maybe even China, it's hardly the kind of robust environment where you can see, hey, could oil prices go from 50 to 100 to 150 to 200, which would be the equivalent of what we had 20 years ago, and the economy's kind of accelerate into that. We've not seen that. We've also not seen the shale rig count go up and shale supply not follow. Now, again, that might change going forward. I do believe there's been a maturing of shale, but I think those would be the two key things I'm looking for. It's hard to see the smoothness of sort of the BRICS equivalent GDP S-curve, income growth S-curve, the straight line up that we saw then. India is expanding now. The rest of Southeast Asia is still expanding. But with kind of all this turmoil in China, that can be a big offset to whatever growth India is happening. So I still feel like super vol is the right language to use, but that doesn't mean we might not make a higher high and a higher low. And so, and I'm sorry, I'm answering these questions way too long, but I'd say in the same way, I would not have thought $67 WTI, whenever it was 2 months ago, was going to be the trough. Usually you'd say a trough is more like 50 or some lower number. Maybe this is a sign that higher highs and higher lows are possible. And if someone wants to call that a super cycle, that's fine. I'm going to say that it's still pretty darn volatile. And if you can go from like 150 back down to 70, that is not what we saw except during the financial crisis 20 years ago. So I think super vol is still the right language, but I actually think there's more common ground between folks in the super cycle versus super vol category versus what really is the question, I think, of, hey, is this business going to go away because of energy transition or so forth? And I certainly do not share any of those more bearish concerns about energy transition leading into any sort of weakening of the oil and gas sector really anytime soon. I don't know when it would occur, but certainly nothing that I can forecast.
Not anytime soon. No, I think that was a great answer. And I think when people think of these oil super cycles, they usually go back to kind of the early to mid 2000s when oil prices higher. They were primarily driven by China, and you kind of point out that recently with the Chinese real estate market, etc., weakening, we've the hit that we get to oil prices from weaker Chinese growth and weaker Chinese demand, could be quite substantial. And you've also talked a bit about how kind of the Asian tigers and the rise of the Asian tigers over the latter half of the 1900s and the early 2000s, and they could actually have lessons for the demand impact ahead from places like India and Africa. So, I would love for you to dive a bit into that and kind of talk about how, India and Africa kind of matter from here, because I don't really think that's been discussed a lot, considering that a lot of super cycle views especially stem from just the supply side rather than, with no real consideration to what goes on with demand. So I would love for you to kind of jump into that.
It's funny, Sri. Sometimes I wish I just called it a super cycle, because it's usually just a heck of a lot easier to explain. Because now we're going to talk about why I think oil demand is going to grow for the foreseeable future. And by that, I mean many, many decades. And I am unwilling to say by this round number date, oil demand is going to magically peak. Yet I still stick with the super vol language. It would never be easier to just say I'm bullish oil demand long term and a super cycle. But I think the path will be choppy on demand. I think we can go through decades where it flatlines, as we've seen in coal and other commodities, before then the S-curve benefits. And what I mean by S-curve, of course, is countries going from being poor to middle class to then rich. And the classic example is Japan post-World War II. A more recent example is South Korea, which has gone from using 1.8 barrels per person per year to about 20 barrels per person per year. They did that from 1970 to current. And here in the United States, where I live, in Canada, where I believe you live, we are using about 20 barrels per capita, rich, successful, developed countries. Europe is down to 10 or 11 barrels per capita. It's a different dynamic there. The rich countries overall, the lucky 1 billion, as I say, US, Canada, Western Europe, Japan, Australia, New Zealand. I need to actually add South Korea to that. I haven't done so yet, but 1 billion people use 13 barrels per capita. The rest of the world, the other 7 billion people, they're using 3 barrels per capita. And then, of course, there are places like India, 1.4 billion people, Africa, 1.4 billion people that are like under 1.5 barrels per capita. China went from 1.5 to just over 3.5 during that BRICS miracle phase from 2002 to the late teens. And to me, that is the point of, as you become rich, you use a heck of a lot more energy. You use all forms of energy, but of course, you use what is available, and that could be crude oil, it could be natural gas, it could be coal, it might be nuclear, and it might be new stuff. And when you look at these statistics, and when you look at how few of us are really rich, it is only about 1 billion of us. And of course, within the 1 billion, there's different strata. We're going to skip that for this moment. But as a society, 1 billion of us are in the rich category. 7 are in the aspiring to be rich category. And so my comment to everybody, whatever one thinks about climate, whether you're it's an urgent climate crisis type mode, or if you think, well, yeah, we need to decarbonize, but we've got a long time to do it. Wherever you fall out, and then of course some people think it's all nonsense, but I'm going to skip that category.
Yeah.
If you take seriously the need that ultimately we need to take care of the environment and carbon's part of it, then it's a question of time scale. And all I'd say is, wherever you fall on the spectrum of urgency or less urgency, how are you meeting the energy needs of everyone on Earth, but certainly these other 7 billion people? And to me, it's a hierarchy of needs. You have to have it. You will always take 24/7, 365 energy. And unfortunately, not everyone gets it. So then when you look at your total addressable market, to use a tech term, and you just say, if the developed world someday becomes rich, and it may not be over 30 years, sadly, it may take 100 years or even longer, whatever decadal long time frame you want to use, that is your total addressable market. And with population growth versus 102 million barrels a day today, if everyone was at 10, so the rich countries go from 13 to 10 because of electric vehicles or what have you, the developed world goes from 3 to 10 because they become richer. In some ultimate time when there is true economic justice and everyone is similarly rich, that's a 260 million barrel a day oil market. Now, Sri, that's a massive number. It's 102 million barrels a day today. 260 it's almost a preposterously large number, which is why I don't actually quote it in any of the research. That to me is why the world is trying to do different energy transition technologies. I don't think electric vehicles will be 100% of the transportation market, but they will be some share. Perhaps countries like India or other nations decide to somehow disincentivize heavier and heavier cars, as we've suffered from here in the US, basically the SUV effect. How can you moderate it so that you do have some fuel economy and efficiency gains and avoid some amount of oil demand? Maybe, unfortunately, some people don't get rich. Maybe they sadly stay poor, or there's war, or there's COVID, or what have you. So the question is, you're trying to eat away from this total addressable market of 260 million barrels a day of oil. The idea that you're going to do that by being negative 50% on fossil fuels and positive 150% on the new stuff is like, it's a ridiculous mix.
Yeah.
We are currently 80% fossil fuels, 20% other. And of course, of the 20% other, some of it's burning wood and bad biomass, but let's just count it as other. It's not going to be, negative 80-20 is not going to be negative 50-150. That is the basic math on energy transition. It's ludicrous. So if you're even 20-80, 20% fossil fuels, 80% other stuff, it would be miraculous. And you will still have a lot of oil demand growth, let alone if it's more likely to be 70-30 or 60-40, or these percentages will change over time. But to me, you have to start with the energy needs of the world. But recognize these timeframes can be long. So if we're currently in a period where US has economic challenges, Europe clearly has economic challenges, and China's economic challenges, then maybe that growth from India and the rest of Southeast Asia will result in only a moderate increase in oil demand. That is far better than what the doom and gloomer, the world is ending, net zero by some short time period, people would tell you. But it's also a far cry from the super cyclers who would have just sort of up and to the right oil demand growth either. Again, all of that leads into very constructive long-term oil and gas demand view that I have, but I recognize for decadal type timeframes, it could flatline a little bit, or at least not grow as robustly. And that is why, again, I get back to super vol versus super cycle for the commodity price.
That makes a lot of sense. And as you mentioned, there is kind of this view, especially with politicians, that we need to get to net zero by, say, 2050. And more realistically, given kind of your analysis of what global energy demand looks like, and how that's going to evolve over the next few decades. I guess realistically, what's kind of a more realistic target to get to a net zero target? By when do you think approximately does it make more sense?
I feel like trying to figure out the year we're going to actually get to net zero is a little bit like the sort of peak oil demand forecast, which is I'm not sure if there's really a year that we know about today. What it will take would be some of these new technologies to truly ramp at scale. It's going to take some regulatory changes for sure. It might take a price on carbon. It could take banning SUVs. It could take any number of steps. But again, centered on how do you meet the world's energy needs as the first and overarching objective. And then to do that with the small of environmental, clean air, clean water, biodiversity protected, and then ultimately, a less carbon intensive environment going forward. And I think when the world is spending trillions of dollars on new stuff, something will work. And I use the example of India versus China. China, as they industrialize in a very heavy industry, property market, export-oriented type of manner. And they went from being balanced on their oil supply demand, or a slight surplus, in fact, to importing 10 to 12 million barrels a day. They became the world's largest oil importer. Ironically, at a time, the US went from being the world's largest oil importer to being almost balanced. And with the help of Canada, basically US plus Canada is on a liquids basis in mathematical balance. There's some exports and some imports, but in mathematical balance. This is a huge geopolitical shift in favor of the US with Canada's help and away from China. And if you're India, there's nowhere you're going to look at this and say, hey, I want to someday be dependent on Russia and Saudi and Iran and all these fun places, or for that matter, even the US and Canada. They may not want to be dependent on us, even if as an American or you as a Canadian might think these are great countries that people should want to be dependent on. Maybe they won't see it that way, right? So they will be motivated, absolutely, to electrify as much as possible. But again, for anyone who's been to India, the idea that, large parts of India can just plug things in at a whim, like it's laughable, right? And so not everyone has a nice single family home as I live in with a garage where you got the home charger and stuff. And there'll be different solutions over time, but these things all do take time, and they do take technology, and they take CapEx. I think India will be very motivated to not go down China's route of being the largest oil importer. And again, that's why I do subscribe to the need to invest in a lot of quote transition technologies. I think the climate folks would do themselves some service by it is going to be geopolitics that drive this much more so than energy transition. And again, the events of the Middle East, where we started with, who would want to be dependent on Iran or Saudi or some of these countries are fine. Some of these are obviously not fine, depending on your perspective. But whether they're fine or not fine, you're not going to want to be dependent on them. This is why coal persists. Coal continues to grow. It has never been lower than it is today in terms of demand. We're at an all-time high in coal demand. It was up in 22, up in 23. It's going to be up again in 2024. And it's because it's a domestic resource for a lot of places. And so there's going to be a lot of motivations to transition. We just don't know what's going to work and when it works. If something does work and does scale up, then it can actually scale relatively quickly, meaning within a decade or even 20 years type time frame. So it's not about this idea of losing hope or this kind of stuff. It's silly kind of talk. It is about meeting the world's energy needs. There's going to be a motivation to do new stuff, and it is a question of when and over what time frame do these things scale. Putting these artificial time frames like net zero by 2050, perhaps it creates a sense of urgency that is needed. I mean, maybe it does. But I do think every country every day feels an urgent need to provide low-cost energy for its people. So in some respects, that urgency has always been there. And the geopolitics keep reminding us that there's an urgency today to replace your oil imports from places you don't like. So that urgency has always been there. So we may solve the net zero thing through other means. Just a final point I'd make is most of the worst case climate scenarios are increasingly off the table. I mean, the sort of over 3.5 degrees of warming, I think even over 3 degrees of warming versus that pre-industrial baseline, those are essentially off the table. And they may say, well, Arjun, you just articulated how oil demand could go up for many, many decades, and those views assume that that doesn't happen. Again, I'll say that with enough time, I don't publish 260 million barrels a day as the 21-23 oil demand forecast, because I think there'll be a significant motivation to chip away at that. And whether we chip away, I don't think we're going to chip away 100% of that. So whether we chip away 50% or 20% or 80%, that's then going to define some of this outlook. But the timeframes are also long. And so again, I think the world should feel good that a lot of those worst case scenarios, for a variety of reasons, are off the table. And then it's just a question of maybe 1.5 isn't the most plausible scenario. So then where in the twos are you, or are you still at 2? And I think those would be the kind of numbers on the climate side to debate. So.
Gotcha. No, that's great. And I think, one thing that you kind of distinguish is, places like India, et cetera, being dependent on, better countries or these more geopolitically friendly countries like US or Canada versus, the fun countries like Saudi Arabia, Russia, et cetera. It's quite interesting because, when you look on the renewable side, especially when it comes to the construction of an EV, the cobalt for that, it comes from, the Democratic Republic of the Congo, which you can 100% trust. So it's quite interesting that, the supply chain on the other side is not, it's not that black and white either. So, a lot of the rare materials, they come out of China, which are going to be very, very necessary for this energy transition. So, so I don't know if you agree with that. And, kind of on the flip side, what's kind of your take on nuclear as kind of, being a leader in the transition? I'm a strong believer in nuclear energy, and I think, that's going to be, a big part of the energy transition. It's not going to be all renewables. A lot of it has to come from nuclear. And maybe I'm just being Canadian, Ontario is about 60% nuclear, and which is great. But I just wanted to get your take on kind of one, is the converse, if everyone used an EV, is it really all that much better, or is that, is the supply chain really that good? As well as kind of your take on nuclear energy as a solution, or as, the role of nuclear energy in the energy transition.
Yeah, a lot of great questions in there. I mean, first, I know you know this, but a reminder for the broader audience: if we went to 100% EVs globally in some mythical scenario, that is still only a quarter of the oil demand barrels. So there's still the other 75%, whether it's diesel for heavy trucks, whether it's airplanes or what have you, that would need to be addressed, plastics and so forth. I would say that clearly there's a dependence right now in the metal space on, differently unfriendly and challenging places, whether it's the DRC or China. That does not have to be the case. So there clearly is copper, there clearly are rare earths minerals, there are clearly all these things scattered throughout the world, by the way, including the United States and Canada for that matter. And then we have the question of sort of environmental NIMBYism, who, there's one group that sort of protests climate, there's another group that protests mining. It was actually on the Macro Voices podcast. Dear climate people, please don't go to the net zero by 2050, protest on Saturday and then go to the anti-mining protest on Sunday. You're gonna have to pick one of these things, right? And so I thought it was a great line. I forget the guest that Eric Townsend. Oh, it was actually Eric Townsend who that was his quote.
Okay.
Anyway, it does not have to be the case, and I do think there's it's not that there's a lack of honesty. There's a lack of, for some reason, there's an unwillingness to push back on some of these inconsistencies, which are really mind-boggling. So for those that really do care about meeting net zero by 2050, I may think, they're being zealots or any number of different words, but if they really do believe it, well, I don't understand why they then don't push harder on other things. Banning SUVs is another sort of solution. It is, we have missed 90% of our fuel economy targets. Someone will say that's not politically feasible. I'm not passing moral judgment on driving an SUV. I'm just saying that if you actually cared about climate, you would ban SUVs and push that as a policy, as an example. You mentioned another great area to push, which would be nuclear. And I learned the fact I did not realize Ontario was 60% nuclear in its power generation. That's terrific. So I know obviously France has the potential to be 75, 80% nuclear when the plants are running. And so it does show you don't have to depend on fossil fuels. We often choose to. And so certainly in the power generation mix, I do think one of the more encouraging things is that even the diehard climate people now do talk about solar and wind as being intermittent resources. And I think that's become very apparent as they've gained a bigger and bigger share of the power generation mix, that it is problematic in what are dispatchable grids, and it's certainly on-demand expectations by consumers to not have intermittent sources be so prevalent. And nuclear certainly is one of the solutions. You know, natural gas and coal are the other solutions. And again, people can like or dislike any of these things, but you're going to need some amount of firm power, especially in lieu of battery storage being economic or even carbon friendly for that matter, anytime soon. And whether geothermal is part of the solution, whether there are other solutions. I mean, these are the kind of things that I think the world is investing. It will try to figure out. I will say this in defense of solar and wind. While they are intermittent, while the arguments against energy density and biodiversity challenges and all these things are very real issues for sure, they are a domestic resource once they're up and running. So again, if you think of a place like India, are they more likely to want to do solar and wind if they can? Or are they going to be more likely to want to import LNG from a foreign country that they're paying world equivalent oil prices for? And this is where I think there is solar and wind are absolutely going to be part of the solution. Again, I'd say for geopolitical reasons more than anything. And I do think it's intriguing that once you pay for the capex, your variable costs are de facto zero. There's certainly they're not zero, but they're very, very small, subject to some amount of maintenance and panel replacement and so forth. And so that is an exciting proposition to have paid for the capex, and then the go forward, electricity price being on the margin near zero. Again, you need some amount of firm backup and so forth that you have to pay for. You got to pay for transmission lines. You got to pay for a bunch of stuff. But this is where I think the fossil fuels are the only answer type crowd. I don't think that's accurate either. I think you mentioned nuclear, wholehearted. If people were truly, concerned about quote climate crisis, we would have a nuclear Marshall Plan. And it's always interesting that suddenly politics get in the way when it comes to kind of the real tough solutions, which again, something like banning SUVs or promoting nuclear would probably fall in that tough to convince the public type category. Where instead they just yell at fossil fuel companies. You can yell, I'm an investor, I'm an analyst. I spend plenty of time yelling at fossil fuel companies. It's not about yelling at them or not yelling about them. It's about why do people use energy? And there's just so much misinformation about why we use energy. We don't use it because fossil fuel companies jam it down our throats, or that they somehow protested some law or lobbied against some law that would have changed. So it's utter rubbish that we use it because they're abundant, they're inexpensive, and they fuel 80% of our economic and livelihoods. Everything. It's not just driving cars. And so people, I think there's a need about what is going on. So.
Yep. No, 100%. And, kind of going back to, what you mentioned, you kind of have to think about, or, you as and you, Arjun, you get to think about these, you get to think about the O&G sector kind of as companies, as, kind of the equity investor, and, with kind of that business mindset. And, one thing that you mentioned, earlier in this podcast was kind of the dynamics around cost curves in the energy sector. And, you talked a bit about how cost curves have steepened. So for our audience, could you kind of explain what that means and, kind of how that's evolved over time, and, what this kind of means for the capital allocation from a business standpoint?
Yep. So in terms of cost curves, so like when looking at any sort of commodity sector, and this is certainly true for oil and gas, I think one would look at what are all the future projects that are out there and what is the cost of those projects coming online. And so when in terms of cost of projects, it typically means that at what oil price would the project kind of quote break even. A break even may be to earn a 10 or 12% return on capital for the investor. It doesn't just mean that the revenues equal the cost or something like that. So it's break even to provide a sufficient incentive to the capital providers, usually the oil companies themselves or their investors, to want to move forward with the project. So you build up these, quote, cost curves. And what you find is over time, they flatten out, which means you have more supply at a given price, or they steepen, which means you have fewer projects, and therefore to add on new supply, you have to invest in an increasingly higher cost project, or hopefully start exploring or doing stuff to try and flatten out that cost. And that's kind of the cycle where these cost curves, and I'm using analyst speak here, but they either are very flat, which means you have a whole bunch of supply that can come on at a given price, or you don't, and that would be a steeper cost curve. And we've noticed that after flattening out from 2009 to 2017, during the shale boom, you added a whole bunch of shale supply at like $50 and $60 oil. You're now starting to drill through a lot of that shale, and therefore the projects you're left with, there are fewer of them, and they require a higher oil price to kick in. Now, that would feed the super cycle type commentary, and which is why I've started shifting a little bit more to saying, I still think super vol is the right answer during this period of uncertainty for China, Europe, and US economically. But as that cost curve steepens, as shale matures, as we continue to drill through tier one, and until we see evidence that tier two, tier three has now dropped in cost through new technology or what have you, that it could lead to a super cycle, especially if the economic situation in these places ever does get better. And so we've not seen the crunch yet. I think where you'd see it would be at the back end of the oil curve. So 5-year forward oil during the 2000 cycle, it used to be 5-year forward oil was 20, whether the spot was 15 or 25, and it moved up to 30, 40, and kept going up till it ultimately got to about $100 a barrel a decade later. This time around, the long end of the oil curve had been around 50 from 2015 to 2020. It's now kind of between 60 and 65. So it's crept up a little bit, but it is not sort of rocketed higher. So again, we're seeing the cost curve steep, and we're seeing fewer projects being available, shale being drilled. But I do think it's the economic challenges that are keeping back-end oil from really kicking in. And it's hard for me to say when, because things might not come down in China economically for a long time. They probably have reached peak population, and they're going through some transition. So do things get better in Europe? That's also hard to see given Ukraine and their own energy transition madness and so forth and what they're doing. And that kind of leaves then the US plus India or the rest of Southeast Asia, maybe someday Africa, to kind of fill in that gap. And, things are okay in India, they're okay in Southeast Asia. US is kind of mixed, but in aggregate, it's not been enough to really offset the weakness in China, such that we have a super cycle. We've got a kind of a bullish price environment, but not super cycle. So,
Gotcha. That makes a lot of sense. And when it comes to kind of thinking about the cost of production, when it comes to thinking about marginal costs, I was very curious about the marginal cost of natural gas production and kind of how you've been thinking about it. So, over the last year, especially over the winter, we saw the winter was a lot warmer than what the market expected, and we saw Henry Hub natural gas, I think it fell below $2. And so when it comes to thinking about what's kind of your estimate for where marginal cost generally in the industry lies, and how long would that have to be sustained for it to actually matter to supply?
I mean, if we're talking about the US and Canada, to me, there's just a lot of natural gas in both places. And typically the issue is as much about pipeline availability and export capacity and these kind of things than versus simply the drilling economics. And of course, in part, drilling for gas can get complicated by, is there a liquids component to it? And does that subsidize some of the gas production or what have you? But certainly a Henry Hub price in US dollar per MMBTU terms, somewhere between $3 and $4 a barrel, an MMBTU, that does seem to motivate over time sort of adequate supply relative to demand. I think, as you correctly point out, if you have a cold winter, these prices can go way above that normal price. And of course, in the opposite, can go below it. I think what is interesting is you're starting to see the US partly connect to the rest of the world. So LNG prices, liquefied natural gas, those have generally been priced closer to oil equivalent prices in most other parts of the world, in sharp contrast to Henry Hub, which have been, a fraction of the oil price and really bearing no relationship to it, certainly for all of my career, the last 30 years. And so as the US has gone from zero to being the world's number one LNG exporter, which is a remarkable feat over the last decade, you're starting to see Henry Hub somewhat link up, at least directionally, with some of these global LNG prices. So that is having a big impact going forward. I'd still probably be I'd question, though, let's just say very strong LNG prices and let's say for those who are in the oil supercycle camp, let's just take that view and say that leads to equivalently very strong LNG prices since they're often priced off of oil. Would that then lift Henry Hub? And I would probably be concerned that if you start getting to $5 or $6 Henry Hub, I'm not sure why you wouldn't then have a major supply response. Could go back to the Rockies, the Canadian Rockies for sure. The Permian gas people don't really talk about. Now that's often associated with oil, but it is there. Eagle Ford has always had a huge gas play. But again, people have focused on oil or liquids. So it's hard for me to be super bullish on Henry Hub or Canadian gas prices, but that doesn't mean you can't earn a good living. And so oftentimes there is such an abundant resource for the companies that are slightly below the cost structure of other companies. They can earn a decent return. So you've had some, some local natural gas companies that have been good companies, even absent a bullish price. And it's an important point that we're kind of getting to here late in the podcast, which is it's not just about price. It's about your costs. It's about your capital efficiency. It is really about returns on capital, which are they are absolutely not one-to-one correlated with prices. They can be in the short term. I would say they're not in the long term. And so it is quite possible to earn a good living as a gas producer, even in a non-super bullish environment. Independent of it, exactly. And so the final point would simply be is for some of these companies, there is going to be an opportunity to export U.S. or Canadian natural gas as LNG. And I think some companies have that business model. It's an interesting one. It's not for everybody. It's usually for bigger companies, but that could be part of it as well. So
100%. Awesome. I think, that's kind of a great place to stop. And I just wanted to ask, is there anything that we haven't discussed or, anything that, you wanted to mention that, have not been able to go over?
No, I mean, I think we've talked a lot about it. I think maybe just as a final point, I mean, it's a great sector to learn about. I appreciate your interest in the sector and inviting me on and asking about it. I think there's a lot of lack of energy literacy that's out there. I think 100%. People have become sort of climate only in their perspective, and there's no chance that you'll ever solve the quote climate crisis by only focusing on climate. Because at its core, it is an energy issue, and energy at its core is a human prosperity. It's how we live our lives. There's nothing we do that is without it. People think energy is just turning on your light switch and driving your car, when that is a portion. It's an important portion, but just a portion of it. So even this Zoom call, the headphones you're wearing, my sweater, everything you can see, even my fake background, all of it is driven by energy. And 80% of that energy is fossil fuels. So not a question of liking or disliking fossil fuel companies. That's a separate question. It is about the criticality of energy, why we use it, and how challenging it is to change the system. People say, well, you're just saying that because you're either invested in or associated with fossil fuel companies. Like it is only personal attacks that is the counterbalance to understanding energy literacy, right? And so if something can scale up at cost, absolutely, it's going to take over. And as an analyst, I would want to know that. I'm not looking to sort of like own fossil fuel companies into the ground if in fact their fate is about to go away. In fact, just the opposite. I mean, I am searching extensively for what would cause my oil demand view to be wrong, or what would cause my natural gas view or LNG view to be wrong. What new technology is going to, but we spend a lot of time at Veriten talking about all that stuff. It is not about, oh, I only believe in fossil fuels. Not at all. I consider myself an analyst first. But I think we have yet to see how you're going to meet the world's substantial energy needs without some significant portion of it continuing to come from oil, natural gas, and by the way, coal as well. It should come from nuclear, and I'd love to see nuclear be part of the answer. And it should come from new stuff, but we're going to have to spend some time and some money figuring out what that new stuff is, the time scale in which it can all ramp, not just some of it, not just about ramping solar or EVs in rich countries or even EVs in China. It is about meeting the needs of 8 billion people on Earth. And that's going to take a lot of all forms of energy in the coming decades. So
100%. No, I think that was a great kind of closing comment. And for our audience who want to find more about you and your work, where can they find you? The Super Spike podcast and the Substack is awesome. So
all my stuff is available on Veriten, and at veriten.com, somewhere at the bottom of the webpage, veriten.com, there's a sign up for both my Super Spiked email as well as the Close of Business Tuesday general public hour-long podcast that Maynard Holt kind of leads and a bunch of us participate in. Or on my website, arjunmurti.substack.com is Super Spiked as well. And that will get just Super Spiked. And all this, whether you do Veriten or the Substack, you'd get both all the written stuff I do and the videos that I do, which are kind of every 3 or 4 weeks is the podcast. So
awesome. That's amazing, Arjun. Thank you so much for being on the podcast. It was awesome to have you on.
Sri, thank you so much for having me. I loved your questions and great to be here.